County Hospitality Association. Today, we are pleased to present a program on insurance hot topics, sponsored by George Petersen Insurance. We have our guest speaker today, Tony, who is the Vice President and Agency Principal of George Petersen. So Tony was born and raised in San Francisco. He joined George Petersen in 2001 after a career in technology, in which he was the CEO and founder of a digital media distribution company. With a focus on complex property risks, Tony specializes in professional and management liability, along with an emphasis in the manufacturing and hospitality industries. And Tony became a principal at George Petersen Insurance in 2010. So thank you so much for being here. We're excited to hear your program and see the slides you put together. And I'll kick it over to you to take it from there.
For sure. Well, thank you for those of you that are in attendance, taking some time out of your busy schedule to hear this presentation. Thanks again to Tiffany and the Sonoma County Hospitality Association for giving us the opportunity. So some of the things that we're going to talk about, we're going to bounce around to a few different topics that are specific, obviously, to some of the insurance changes that are taking place on the landscape. We're going to be talking a little bit about the class code change for restaurants that's coming up just after September 1st of this year. And then we're going to dive into a few types of coverage. We're going to talk about the importance of employment practices, liability insurance, network security, also known as cyber liability. We're going to dive into a little bit of some of the changes in the marketplace in terms of why insurance is becoming as expensive as it is and some of the challenges with that. And then I'll touch just briefly on some of the changes taking place in health benefits and what that landscape looks like moving forward as well. So again, to begin with, we have a new workers' compensation restaurant classification that is just about to take place. So effective September 1st this year, the class code that restaurants have been using for many years, class code 9079, is having a change that's taking place. And one of the drivers of this is that over the past few years, as the WCIRB, who is the Workers' Compensation Insurance Rating Bureau, they are a quasi-state organization that develops these individual class codes by which we determine what the job duties are of an employee, and then based on those job duties, they're fit into a class code. And then the insurance carrier uses that class code and they associate a rate or a charge for that. And then for every $100 of payroll that's generated, that rate is multiplied times that, and then you get your workers' compensation premium. So for restaurants specifically, over many years, what makes a restaurant unique is that they have or have had an all-inclusive class code, which means that for the most part, everyone that works at a restaurant is going to be aggregated into one class code, which is 9079. Well, that's now changing. And one of the reasons why that's changing is post-COVID, or at least during COVID, the WCIRB began to see that as a result of changes in operations, there were wide variables that were presented where the class code itself, or the all-inclusive class code, just simply didn't apply. And so what they're doing is they're introducing 6 new class codes for those that were previously allocating their staff members into 9079 to fit their new class codes for their the new classification for their staff now. And so one of the things that's going to be taking place is that if you're looking at these various class codes and you're trying to determine which class code is most appropriate to you, the Workers' Compensation Insurance Rating Bureau has provided not only a definition and detailed description of each of these class codes, but they've also provided a tool. And I will forward a link to this tool to Tiffany that she can distribute to the association members. And essentially what that tool does is it allows you to go to the first screen, you'll answer some questions, you'll be prompted to go to the next screen, you'll answer some additional questions until ultimately when you get to the end, it will establish what the classification is based on the answer to your questions and what the description of operations and duties are that your staff member has. If there was some sort of if you were unsure, or maybe one class code would fit and perhaps a second class code would fit, and you're thinking, well, maybe this fits and you're undecided, And then the question of, well, what is the rate for it? I certainly don't want to choose a more expensive rate to apply to my staff members if I'm unsure. And so one key thing to know is that each of these 6 class codes have exactly the same rate. And so what happens is the WCIRB creates what's called the pure premium rate. And the pure premium rate is basically the baseline that insurance companies use to charge workers' compensation rates when they're issuing policies in the state of California. And so for approximately the next 2 to 3 years, the WCIRB is offering these different class codes, and the rate for each of these class codes is going to be the same until they are provided the ability to collect the data over the next 3 years based on the loss history for each of these class codes. And then once that data is collected and we're told that in approximately 3 years' time, that's when the WCIRB is going to create new rate structures for each of these class codes. So the one thing just to emphasize is don't be concerned if you're overpaying, because you're not overpaying. All of the rates for each of these class codes are going to be the same. So that's some of the change that's taking place effective September 1st and specific to restaurants. There are other all-inclusive class codes that exist, certainly for hotels. Class code 9050 would be another example of an all-inclusive class code. And there are other industries that have all-inclusive class codes. From what I understand and have been told, there are no other class codes that are under review at this time. It's not to suggest that that won't take place, but my understanding is that at this time, only the 9079 class code is under review. So with that being said, the next thing we'd like to talk about is the importance of the experience modification and the unit statistical report that's generated during the policy period to help determine what your premium or how it impacts the premium that you pay. So the experience modification is essentially a grade that's provided to you by the state of California. And that grade is based on the number 100, kind of like a baseline that they use. And anything that is under the number 100 is a credit to you, and anything that is above the number 100 is a debit to you. So I'll give you an example. What the WCIRB does is it takes data from the insurance carrier, which is basically your loss history and the payroll that you pay, and they use a calculation, and then based on that, it releases a number. And if you have favorable loss history, you have a credit experience modification, or under 100. If you have adverse loss history, then there could be a debit over the number 100. And how that number is used is that when the insurance carrier is determining what your premium is going to be, they will take the rate times the payroll, and they'll come up with the premium. Then they'll look at what your experience modification is, and if it's a credit, say an 80, they will credit 20% to your premium, along with some of the other factors that they use. Conversely, if you have a debit mod, they will take the rate times payroll, come up with the premium, and if your experience mod is, say, a 135, they will apply a 35% debit onto your workers' compensation premium. So as you can see, the experience modification is pretty important, and it has a large impact in terms of how the pricing structure will swing for you. And so what is done is midterm during the workers' compensation policy, before the data is provided to the WCIRB, a unit statistical report is completed. Basically what that is that we contact the insurance carrier, we collaborate both with the policyholder as well as the claims adjuster to make sure that, for the most part, that the claims are reserved properly and updated as much as possible. And the reason why that's important is because claims reserves have a huge impact on, obviously, your loss ratio and how that can impact your experience modification. So if we're checking, for example, on a claim that has $5,000 that has been paid out, and let's say that there's a $35,000 claims reserve on it, then the total claim value of that claim is $40,000. And during the unit statistical period, when we're interacting with the carrier, there may be new data that comes up. For example, if we have an injured employee and they are scheduled for surgery and they had recently had a qualified medical examination that has now revealed that surgery is no longer needed, we would collaborate with the claims adjuster, make sure that they're aware of this new information. And then at that point, our objective is to reduce the claims reserve. So now that the staff member no longer needs surgery, instead of having a $35,000 claims reserve, maybe we could reduce that value down to, say, $10,000. And so now when the data is provided to the WCIRB, instead of that claim value being $40,000, it's now $15,000. So a large part of the unit statistical report is to make sure that the data that's being provided is as updated as possible, is as accurate as possible, and the claims reserve are as low as possible. And so when that data is provided to the WCIRB, you want to make sure that we can get the experience modification as low as we can. In that process, what we do, or once that process is completed, we're now able to project what the experience modification is going to be. And that's important information for a business owner. This generally would take place about 6 months into the policy period. And so if you're going to see a large swing in your experience modification, and let's say, for example, that there is a potential rate increase of 10%, and your experience modification is going to go from a 100 to a 130, then you add the 30 plus the 10% rate increase, where now you could see that there is the potential of a policyholder seeing their premium go up as much as 40%. And so that's important information that's generated from the unit statistical report. And so what we do is we generate that information, we project and calculate what the renewing experience modification is going to be. And then what we'll do is we'll contact the insurance carrier and we'll say, okay, well, if we have an experience modification that's going from a 100 to a 130, do you have any potential rate changes that are going to take place over the next 6 months? And what we do is we'll use that data to be able to project, with a fair degree of accuracy of what the renewal premium is going to be. So conversely, if you have a positive loss history, you have claims that are falling off, you have claims reserves that have been reduced, and you're seeing your experience modification, say, go from a 100 to a 75, and that would be a 25% credit. Obviously, from a budgeting standpoint, that's important information to have. And so the experience modification is a large component to what we pay annually for our workers' compensation premium. And that unit statistical report, as you can see, is a really important part of that process, both from providing you the intelligence that you need to find out what your XMOD is going to be and how that's going to impact your premium, as well as making sure that the claims are being handled properly, that people are paying attention to them, and that appropriate claims reserves are taking place with them. So again, the experience modification, big factor in the premium that you pay, and the unit statistical report generally provided by your broker is something that you'd like to see happen. So moving on right now, one of the things that we wanted to talk about are some key coverages. And one of the key coverages that I wanted to talk about was employment practices liability insurance. It's also known as EPLI. And EPLI is a very important type of coverage to carry for any business owner, but in particular, the hospitality industry. EPLI responds to claims that emanate from the employee to the employer. And it focuses on 3 primary areas. One area would be wrongful termination. The second area would be workplace harassment. And the third area would be discrimination. And so, again, EPLI would respond to those 3 components of allegations that are emanating from an employer to an employee, or from an employee to an employer. One of the key components to an EPLI policy is that you can add or broaden the coverage. And there are 2 areas that we primarily focus on when we're providing employment practices liability for our clients. And one is adding a wage and hour defense sublimit. And what wage and hour does is you can have allegations that emanate from employees. It could be a single employee. It could be a group of employees who have indicated that they weren't paid properly, they were underpaid, they didn't get paid for specific duties that were performed, commission structures weren't allocated properly, and then they can file a complaint against the employer in which the employer would have to defend themselves. And so in that process, a wage and hour defense sublimit is essentially a bucket of money that the employer can use that does a few things. One, It pays for the defense counsel that would be triggered and assigned to defending the allegations. And then two, there's a lot of record keeping and record retrieval and other things that are required when you're defending a wage and hour claim. And so what the wage and hour defense sublimit does is that it provides that extra bucket of money to go towards those defense expenses and clerical expenses and other type of expenses to retrieve the records while you're building your case. One of the things that wage and hour defense does not do is that, let's say that in the end of that process, it is discovered that indeed we do owe these employees money. The wage and hour defense supplement will not provide the money to pay for that. That would be borne on the employer. So one of the things to know is that that wage and hour defense supplement is really just for the defense and expense of it. But again, if it's revealed that we do owe staff members money, it's not going to provide the resources to pay those monies out. A second thing that we will always traditionally add to an EPLI policy is a third-party liability endorsement. And essentially what that does is, going back to what I was talking about with EPLI, EPLI is designed to respond to claims that emanate from the employee to the employer. When you add a third-party liability endorsement to an EPLI policy, now it will trigger two types of coverage that come from the general public, from a third party. One is discrimination, and the other is harassment, workplace harassment. And an example of that could be, and I know Tiffany and I were talking about this earlier, is there's been a bit of an uptick in people having their websites reviewed. And if it is found that a website is not ADA compliant and someone wishes to seek damages against the owner of that website, let's say that they are visually impaired or hearing impaired or some other disability, we have begun to see an uptick on this. This would be an example where the third-party liability endorsement would be triggered to defend the employer or defend the website owner in this situation, and then indemnify them for that. So a third-party liability endorsement component to an EPLI policy is very, very important. Another good example of how the third-party liability endorsement would work, particularly for a hospitality exposure, is a claim that I had years ago. I insure a hotel that's a historical site, and due to its age, all of the rooms in the hotel are on the second floor, and there was no wheelchair left or elevator. And we had received a letter one day from an attorney representing someone who was wheelchair bound that said that as a result of my client being wheelchair bound, they did not have access to any of the rooms. And so the term that was used was constructive eviction. My client was constructively evicted from the premises due to their disability. And as a result of that, we're going to seek damages against you. And this was a claim that we had. Indeed, it did trigger the third-party liability endorsement for an EPLI policy to both defend and indemnify our client for that situation. In that particular situation, our client was required to build a lift that provided access to the second floor. And part of that settlement did not include the expense to build and remediate the location to accommodate a person with disabilities. But it did trigger its duty to defend and then indemnify from a third-party discrimination allegation. So as you can see, with wage and hour defense sublimit added and with the third-party liability endorsement, and then with the first-party coverage that's provided with an EPLI policy, EPLI is a very important coverage, and I would highly, highly recommend it. The next area that I wanted to discuss was the importance of cyber liability or network security. And network security coverage is a type of coverage that we're seeing come into play more and more as each year goes by, where we have greater vulnerability from a cyber attack. And so what cyber liability does is it protects the employer in several components. The first thing is that it provides the employer with the resources that in the event their systems have been suffered an unauthorized breach, and they come in the morning and they turn their computer systems on and they have no access to them, a cyber liability triggers a team behind you. And what that team does is they do an IT diagnostic to see if they can identify the source of the breach, to see if they could rectify that breach and get your systems back. And you have a full team of individuals that are working behind the scenes because, as you can imagine, with all of our systems down, particularly today, not much of us can do business without the use of our computer systems. And so what a network security policy does is it triggers this team to jump into action and to try to remediate this situation. If it is discovered that the unauthorized breach cannot be remediated, then it triggers another part of the coverage that's provided by the network security policy, which is actually ransomware. It is negotiating with the cyber terrorists to come up with a fund or a dollar value in which they would pay the cyber terrorists so that they would release encryption codes in order to get our systems back. And so that is also a component of network security or cyber liability coverage, is that if we are unable to remediate, determine what the source of the breach is and rectify it, and now we have to engage in a negotiation process to have those encryption codes released and get our systems back, the insurance policy, believe it or not, will pay for that. I have had many situations like this. One may think, well, why would an insurance policy pay for this? Or what sort of assurance do you have that once that ransom is paid, that we actually get our encryption codes and we get our systems back? Well, I've actually never had a situation where the encryption codes were not released. And I think mostly the reason for that is because this is really a business model for cyber terrorists. And so in the event that they were to receive the funds and not release the encryption codes to allow us to restore our systems, then I think that would change the landscape of how we respond to cyber attacks. And that's generally why the cyber terrorists do participate, cooperate, and ultimately, once those negotiations are complete and the ransom is paid, those encryption codes allow us access back to our systems. So the cyber liability policy pays for all of those things that I've just described. There are additional things that come along with it where there are some obligations that we have in the state of California if we have an unauthorized breach. One of those obligations are we have to inform anyone whose record may have been compromised and their personal identification information is now out there. So there's an expense that's associated with notifying anyone of a potential breach. In addition to that, should there be records that have been compromised, there's an obligation that the employer has to track the Social Security numbers of individuals whose records have been compromised for 1 year time period. And so the policy will also pay for the expense associated with the Social Security tracking service that's provided. In addition to that, now as we diagnose our systems and we're trying to get our systems back up, we're using the services of our IT team, and in some cases, if we have to discard hardware, a cyber liability or network security policy could respond to some of those expenses. And then finally, if we are drawn into a lawsuit, the liability exposure potentially is covered by the cyber liability policy as well. This could come from a state agency or an individual that, as a result of this unauthorized breach and this compromise, either a third party suffered a financial loss or we were in violation in some way of not following the rules. The policy triggers its duty to defend and indemnify us in that situation. So cyber liability and network security coverage is very important, and I think more and more so as each year goes by and we continue to see this threat rise. So the last thing that I'd like to talk to you about is the impact of reinsurance on the marketplace. And why is insurance becoming so expensive? Why upon renewal are our premiums going up and our coverage is going down? And there are several components that contribute to that. But one of the primary components is the concept of reinsurance. And so basically what reinsurance is, and we'll use this as an example, is let's say that we go to Travelers Insurance Company and we obtain an insurance policy from Travelers for a value of $10 million in limits. Well, Travelers issues that policy as the fronting company, but let's say that Travelers only has $2 million. They have to go to the person behind them and get the remaining $8 million to fill the total $10 million limit for the policy. The person that they go to behind them is called a reinsurer. They're the ones that are providing that additional $8 million worth of coverage to fill the $10 million order. So when Travelers goes to get that additional funds, they have to pay a fee for that. And the reinsurer charges that fee to the carrier, and they provide them basically an appetite guide of what they're going to allow Travelers to use this $8 million for various insurance exposures. So traditionally, over the years, because the reinsurer has millions of dollars of coverage in front of them before their contribution would be impacted, they traditionally haven't suffered a lot of losses. And so the price of reinsurance has been fairly low. Then approximately 2015 or so, we started to see a real change take place. And those changes are that the reinsurance market is essentially getting wiped out almost every single year. So they're suffering significant losses. So even though there are millions of dollars of layers of coverage that are in front of them, essentially protecting their position, it breaches those additional limits. And now the coverage that they're providing is being eaten away at large catastrophic losses. And so we're seeing an uptick in these types of claims and catastrophic losses as a result of increased weather events, severe weather events, social inflation, which is large jury awards that are beginning to take place over the last couple of years. And so as a result of that, every year, when a reinsurer is now going to develop an agreement with a company like Travelers, they'll say, okay, well, we'll provide you with this additional capacity or these dollars to fill those orders, but it's going to cost a lot more now. So we've seen a significant increase in the cost of reinsurance, 60, 70, 80%, or even more. And so when Travelers now goes back to get that additional $8 million to fill the $10 million order, it costs them a lot more to do so. And those costs are passed through to consumers. In addition to that, the reinsurer will now change the rules a little bit. And what they'll say is that, okay, we're willing to give you that $8 million to fill the $10 million order. And it's going to cost you more, but now we're going to change the appetite guide. And the appetite guide can suggest that now if you're going to use this $8 million, you can't insure any property that was, let's say, built before 1995, that is a wood frame construction and that does not have fire sprinklers. So long as you're using this money for everything that's not that type of risk exposure, you're okay. And so that would be an example of now when I'm going to purchase insurance for my business in the marketplace, not only is the expense higher today, but the appetite has changed where now, where I had 10 or 15 insurance companies to choose from, now I may only have 2 or 3, maybe just 1. And maybe the coverage that I get is not only going to be more expensive, but the type of coverage I'm going to get may not fit all of my needs or may have menacing language or exclusions contained in it. And a lot of that is driven by the reinsurance marketplace. And one thing to know about reinsurers is that as they're distributing this capacity or these funds that they're investing into the insurance industry, they do so on a global basis. And so when reinsurers are placing their money into the marketplace, it can both come from Asia, Europe, the United States, Central South America, or other areas. It can also be placed in all of those areas. And the reason why I mention that is one might say, well, what does a wildfire with significant losses in Australia have to do with the renewal of my homeowner's policy? And the answer is everything. Because the reinsurers are distributing their capacity worldwide. And when they suffer their global losses, they make their assessments before they re-engage in what we refer to as reinsurance treaties, or these negotiated terms by which they're providing this capacity to the insurance carriers. And so losses can be calculated on a global level. And so when this reassessment takes place, based on the performance over the last year, can determine globally what the insurance rates are going to be, how much capacity is now going to be reinvested into the marketplace, and then what the policy coverage is going to be, what sort of restrictions are going to be placed on that capacity, which basically restricts the insurance company's ability to provide you essentially the coverage that they probably would want to provide and coverage that's needed by a policyholder, but it's just being restricted because of the reinsurance. So we've begun to see these changes take place. As I said, pretty much back in 2015, we saw some consistent trends. And what's now beginning to happen is that rates are being readjusted. There are other components that go into it. And we are hopeful that we're going to begin to see some stabilization of the marketplace sometime in 2025 or 2026. But we're hopeful that at least when we are in 2025, we could look back and perhaps the worst is behind us. But we do see some stabilization taking place in the future. So where things are today, we're hopeful that they're not going to be that way forever. So there are some signs of that. There is one more item that I did want to add, which is health insurance and what that landscape looks like. We are seeing some trends that are beginning to stabilize also in 2025. Health insurance premiums continue to go up consistently each year. We've seen a significant impact after the pandemic, and the reason for that is a combination of two things. One, use of services. During the pandemic, there were procedures or other services that people had simply put off. That once an all clear was provided to the general public, people were resuming some of the treatments that they had. And so as a result of that, we're seeing an uptick in the use of services with employee benefits and health insurance. And as a result of that, the marketplace had responded and premiums were partially driven up by some of the increased use after the pandemic. Another contributing component are the rising costs of prescription drugs, designer drugs, as they'll say. Some of the ones that are more commonly known that we see commercials on TV, Ozempic and others that are very expensive, are certainly having their contribution to rise of health insurance premiums. And then really just the cost to operate and distribute health services from a distribution standpoint are on the rise as well. Again, some of the feedback that we're getting is the brunt of those increased expenses are being absorbed and incorporated into these increased premiums. And we are, again, hopeful that in 2025, some of the signs are there that we'll see some stabilization of the pricing structure and hopefully see things flatten out. And so in general, that's really just the overview that I wanted to provide to you. I did want to circle back to one item. I'll provide some information for Tiffany, but I'll provide this resource link that you see right here, which is a link to the Workers' Compensation Insurance Rating Bureau that I was referring to earlier. And this is designed to provide you an overview or definitions of those various class codes, as well as that tool that you can use to help identify what is the workers' compensation class code that best fits you if you currently have a 9079 class code. So I'll get that to Tiffany and she can distribute that to the association members. And if you have any other questions, I'll provide Tiffany with my contact information. I would love the opportunity to work with you, speak with you, and assist you in any way